Hi, thank you for joining Volume Spread Analysis Mastery course. Okay, I'm Kaishan here. So today I'm going to start with this one, why we need to know about the volume analysis in the Forex markets. So can you imagine like this is your chart, this is the price chart, right? So there's a flight, the plane. If you want to fly to our target here, so what will you do at the first place? At the first place, the pilot they will refuel their tank, right? Their fuel tanks. So they have need to full tank first before they can fly up high, right? Okay. So over here you can see the chart at the bottom. They will refuel their tanks. So usually, you have the ranging market over here. Okay, they will refuel their tanks. Then after that, they're moving high up. Okay. Once they refuel their tanks already, then they are ready to go, then they will start flying. They are flying. Then their fuel will getting lower and lower inside the tanks. Okay, so when the fuel is lower and getting lower inside the tanks, what will happen? They will start like cannot fly up high already. They're ranging around this area. Okay, they're ranging around here until there's no more fuel. Then the price dropping again. Okay, dropping again like that. Okay, so the same concept, so you apply over here. Okay, this is our price chart. Imagine that this big guy is our big boy. Okay, this guy is a retail traders. Okay, big boy, which is the people that have a lot of capital and money in their hand. Okay, they got a lot of money. Then retail trader like us, we got a small amount of money. Okay, they got a lot of money for big boy. Then this one we got little money. Okay, this one got a lot of money. Okay, so your big boy also have target when they're starting here. Let's say their target is here. They want to bring up their price here. So that what will they do? Because they want to buy the stock, right? If they, let's say they want to buy a stock like iPhone here, iPhone with each iPhone $1,000. Okay, but they want to sell, their target is selling iPhone with $10,000 per iPhone. Okay, so how they going to do it? They were starting with here, they were starting buying the iPhone first. Then you're seeing market starting with the price will go up, ranging like that. Okay, ranging like that. Because they were, when there's a ranging, a lot of trader will trade the range. Then they were over here, they were the retail trader was selling, then your big boy were buying here. Okay, your big boy doing all the buying here. Okay, because this maybe from the downtrend, so a lot of people still selling it here. Then your big boy doing another way around, they are buying it here. Okay, so when there are enough buying in, they will mark up the price high up. Then some retail trader was still selling here because they want to trade because you will see the price moving up down, then before they can going up. This is expansion phase, so a lot of people still selling over here until the price moving up high here. Then only a lot of people jumping in, buy and buy and buy. Okay, but at the initial part here, the retail trader, they are doing selling. Okay, they are doing selling over here, and big boy doing buying. Then the professional trader will come in at here. Okay, professional trader, because once the breakout happen, professional trader will come in here. Then they'll start buying here for the professional trader, then mark up our price even higher. Then only until this phase, our retail trader realize that this is uptrend, so all the retail trader will buy at here. Okay, retail trader all buy at here. By then the other is too late, because the price from 1,000 to 10,000 already. By then your big boy is very happy. Okay, they're very happy. 10,000 per iPhone. They got buy a lot of iPhone just now, so they sold all to retail trader here. Then the price dropped down after that. So in volume analysis, we can see the activity over this area and all along than this area. Okay, you can see the activity. When the price moving up, the volume will be up or down. Then you can see, okay, you can see the weakness and the sign of weakness and strong. Okay, even strong or weakness. Okay, so in this course, going to talk about more about the volume analysis. Okay, just continue for the next sections. Okay, before we talk about the volume analysis, we're going to share with you about the market. There's the two type of market. The first one is centralized market. The second one is the decentralized market. So, okay, what is centralized market? Okay, centralized market basically is like you and me, everyone, they want to do a dealing, right? Buy and sell, they have to go to centralized market to do a dealing. Then because we only got a one third party, everyone go to the same place, so the price will be have a fixed price. Okay, have a fixed price. So in other words, for decentralized market, everyone will go to different broker, different dealer, and different companies, so do a dealing, so their price will be different. So this one, they are more to peer, like I and you, I want to buy and sell to you, you can deal straight away through the internet. Okay, then you through the broker very fast, you can just deal already. Then but there's a lot of brokers companies in the markets. That's why the price for all broker will be different. They have a different spread, but whereas this one centralized market, they have the same spreads throughout the whole market. Alright, so a centralized market is a financial market structure that consists of having all orders routed to one central exchange with no other competing market. The quoted prices of various securities listed on exchange represent the only price that available to investor seeking to buy or sell the specific asset. So in other words, this one for the decentralized market, technology enables investor to deal directly with each other instead of operating from within a centralized exchange. Virtual markets that use decentralized currency or cryptocurrencies are example of decentralized market. So for the New York Exchange, which is this one, okay, centralized market. All right, thank you. Okay, so this video we're going to discuss about types of broker. Okay, so generally they will have a few type of broker. They divided into three, but before it divided to three, they differentiate with these two, dealing desk and non-dealing desk. Okay, they divided to this and this. Okay, so from dealing desk, they further divided into three category. So divided into market maker for the dealing desk. Okay, this is non-dealing desk. So for the non-dealing desk, they further divided into two, which is STP and ECN plus STP. Okay, so now we're going to discuss what is the difference between the broker. Okay, so the most common one, the most lower entry is the market maker. So because they you can enter with the market with a very low capital, with 100, some will go down to the $100. You can enter the market to start trading already. Some will be 200, depend of the broker. Okay, but if you go to the STP and ECN, they need a bigger capital. Okay, so now we're going to talk about what's different. So okay, market maker mainly if you want to buy something, they just, because the previous video we discussed about what is zero sum game, right? Zero sum game. So if you want to buy, someone have to sell to you, right? Okay, so if you are using the market maker platform, so meaning that your broker will take whatever order that they will against your order, meaning that if you want to buy, they be a seller. If you want to sell, then they be a buyer. They always trade against you. But not to worry, because you think that, oh, they trade against me, meaning that they are like cheating, right? Actually not, they are just taking your other side of your order. Okay, so if you want to buy, they will sell to you. If you want to sell, they will take all your buys your or self order, they will buy your orders. Okay, so they make through the money through the spread as well. Okay, just now the spread video is talk about spread. They're making money through the markup, the spread. They take other side of the client trade. Okay, because we will see the price that I previous video I explained the price. You can see the markup price already, so you don't see the real interbank market rates if you're using the market maker. Okay, you can see the price that already mark up from the real price already, so it will be slightly more expensive than the real market. Okay, so they can take your order, right? If market maker, they will just take your order. If you want to buy, they will take your order, they will match through, they will absorb by themselves, uh, absorb by themselves, or they will just pass on to the other client. Okay, they will pass to the other client, meaning that because in the platform, right, they have a lot of people inside their platform. Let's say this is broker A, right? So they have a lot of people want to buy and sell there. So their system will find the price that will match this buyer and seller. They will match it. Okay, they will find the price, the best price, the ask price and bid price that match this seller and buyer. So they are trading among inside the platform. Okay, inside the broker. If there is some trade that they couldn't take by others client, they pass on to the liquidity provider. Okay, so liquidity provider, then they will pass on your trade to the big banks, hedge fund brokers and other brokers. Okay, so they will pass on to outside. Okay, outside of the platform already. So if they are unable to fulfill your trade between their client, okay, their client trade. Let's say you want to buy Euro USD, right? There's one lot which is 100. You want to buy 100,000 units. So you're matching this order with other client or pass to the liquidity provider. Okay. So now we go to the non-dealing desk. Okay, so non-dealing desk means that they do not pass on the client order through a dealing desk. They don't pass to like they don't have dealing desk, rather than they pass through straight away. Yeah, let's see over here. Okay, so they got two tabs. One is straight through processing. Another one is ECN plus straight through processing. Okay, so straight, this one got the T at the back. Straight. Okay, so ECN is electronic communication network. Okay, it's STP is straight through processing. So meaning that if you in the market, okay, you are now in the market. Okay, so this is your trading platform, let's say MT4. Okay, you click on your MT4, you want to buy. Okay, you want to buy. So for the STP, they will send your buy order to the liquidity provider. Okay, they send to this liquidity provider. Okay, then this company, right? They will put your order through, match with the order with the banks, hedge fund, mutual fund, and other broker or other client. They just like intermediate person only. Okay, they pass through your order straight away to the pool. Okay, to the pool of the market. If this is STP, okay. So if there's the ECN, so they will straight away from a trading platform. They straight go ahead with they put your order straight away with the match with the mutual funds, broker, and other client. So the benefit of the ECN is the price. Usually they don't mark up the price. Okay, they don't mark up the price because it's quite straight away to the real market. So they don't mark up the price. But the downside is you will need to pay, like each trading, right? Each trade you need to pay a certain commission. So you need to, let's say, pay maybe $10 per trade. Okay, so there's a commission involved. But if your broker STP on, or is a market maker, you usually pay a spread only. Okay, a spread, they'll mark up the price. So that's the beauty of it. You can pay a small fee, then you can start with the trading already. Okay, but ECN you need the big capital, but good thing is you can get a real price. Okay, and your trading platform, you might have the deep market. You can analyze, you can see the order. Okay, so from STP, they will go through the trading platform, go to liquidity provider, then only they put your order through the pool. Okay, so there's a lot of company. It will be company A, B, and C. Okay, A, B, and C. So their asking price and bid price all will be different. So in that case, so your broker will match your price. So let's say you want to buy at a certain price, they'll match at a certain price that which broker match your price, then they'll sell it to you. Okay, let's say C, they sell it to you because the C they get from the price, they will mark up with different prices. Okay, so for the market maker, so you go through a trading platform, go to market maker. So market maker, either you are trading inside with their client. If not, they will pass on your order to a liquidity provider like that. Okay, so now you can understand more, right? If you based on this chart, you see this is you. If you are trading with the market maker, they will be go through like that. If you trade through STP, they go this way. If you trade through the ECN, they go this way, straight away go to the big bang already. Alright, okay, thank you very much. Okay, this video we're going to discuss about tick volume. Okay, so over here you can see this is my MT4 platform. So the tick volume actually is the movement of the price with in the certain period of time. So meaning that you can see here this is my indicator, which is volume, tick volume. So every point you can see this is 1 point. Okay, the last number. Every movement up and down, you accumulate 1, 2, 3, 4, 5 like that. You see, you observe when the price movement here, your tick will be going up. Okay, you accumulate over this is 1 minute chart, so you accumulate over the 1 minute. Okay, so this is tick volume. So how you're going to open it in your MT4? Actually, you can see here, go to indicator. So you can click the volume. Okay, then you pop up this one. So you can change the color. Okay, if the volume is up compared to the previous bar, then it will be green. If the value is going down compared to the one candle before, not candle, one bar before, so meaning that will be in red color. So you can just change it over here. Then you can make it thicker also. You want to make it thicker, your histogram, you okay, then become thicker like this. Okay. Okay, volume analysis is one very hot topic in the forex because very controversial. People will say that the volume is not reliable in forex market because the market is decentralized market. Okay, so just now I explained to you what's the decentralized and centralized market. So the reason being, partly is true as well, it's decentralized, meaning that the volume is not real. Okay, the volume show inside your MT4 is not the real volume of your orders, but rather than it's just a tick volume. Is a tick volume. Okay, this is because for the central market, they will exchange and put the order in the same place. Okay, in only one place. But in decentralized market, everyone will put their order with the broker A, broker B, broker C, broker D. Okay, got so many broker. So the broker that given you the volume in your chart is not represent the real world whole world volume, but rather than just a tick volume. Okay, so what is a tick volume? Tick volume just simply implying the ticks, like your price is when you see there's a volatile market, the price move up, move down, up and down, right? So every movement up and down, so it will accumulate the tick in the certain time frame. Let's say 15 minute, then with 15 minute the price movement accumulation, then they will accumulate at the inside the 50 minute. So you will see the bar chart like this. Okay, 15 minute. Okay, then the next 15 minute they will calculate again. So the price move up, down, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. After 15 minutes, then plot another bar chart for you. Okay, then you can see your histogram inside your chart. Okay, so but the underlying logic is that with increased order flow, price should generally move more ticks. Okay, so generally this one is not the order volume but rather than a tick volume, but it's true also can represent it will be about 80% accurate as well, because when there's a lot of order, meaning that a lot of price movement, a lot of activity, then this one will be increased as well. The tick volume will be high if the volume order high. Okay, so that's why I personally think that it's quite still considered quite accurate. Okay, but this one also another reason factor you need to put in consideration also, which is your broker, because this tick volume is given by your broker. So now that's why just now we talk about the decentralized, then the broker have a three types of broker: market maker, STP, and ECN. Okay, so generally market maker, they are more prefer to just trade, because among their platform a lot of buyer and seller, right? So they will try to put the trade offset between their buyer and seller inside their platform. Okay, so they are only more to their only inside their platform. But for those STP and ECN, okay, once you put your order, they will once you put your order buy and sell, so they will put your order go to match with the ask any price that match with the liquidity provider. So they have a lot of liquidity provider, so that they're not fixed to only one supplier. Okay, this means they will take from A, B, C, and D. So average out, you are taking throughout the whole world supplier like that. Okay, kind of. So, but rather than market maker, just take only the order, the tick volume. Mainly, they use the tick volume inside among their user. Okay, among their user. Okay, but SDP and ECN, they will take a lot from a lot of supplier and interbank, hedge fund, and mutual fund. That's why I think that the tick volume for these two kind of broker were much more accurate compared to the market maker. Okay, but anyway, I haven't personally tested with the market maker yet, but I think will be still okay, will be still quite accurate. But if you want to be more accurate, then ECN will be the best. Okay, ECN. Okay, so personally I'm using the broker. Let me show you. Just give me a minute, let me show you the broker that I'm using. Okay, just hold on. Yeah, Okay, because I enable the setting, need to reset a while so that I can show you. Okay. So you can see I'm using the IC markets. So IC market actually they are promoting, they say they are true ECN. Okay, they are true ECN account. So you have to check your broker, is it money maker or ECN or STP, so that you can, yeah, it's good to know that what kind of your broker is. So you will, based on the broker, then you will just analyze that is it accurate or not, your broker that provide you the tick and volume. So far using the IC market, I think is still quite accurate. Okay, please proceed for the next section. Thank you. Okay, now we're going to discuss about top 10 ECM STP Forex broker list. So from this website, they are mentioned that there's top 10 here. Okay, you can see the list of the top 10. Paperstone, Hot Forex, Emerald Markets, FB Markets, Forex.com, and so on, Robo Forex. Okay, so this is a ECN broker. So why we are doubt with the market maker volume? This is because that market maker, they are making market for the clients. So basically, if the client A is buying, then client B is selling, they are match the order among inside their markets. If there's no order that able to match, they will trade against their buyer or seller. So meaning that they are trying to keep the order between among their inside their broker, so that that's not that accurate. Because if you take more sample, right, like how you do experiment, you take only one sample, so it's not that accurate. Rather than you like ECN, you take from supplier A, B, C, D, E, F, G, like that. So each you take one sample, so average out, so your tick volume will be much more accurate compared to market maker. But this is what my personal thought. So I think because so far I'm using the IC market, is still not too bad for me. Okay, so let's check more. You see well, Australia broker, Paperstone, IC markets, so as XC traders, Vantage FX, then okay, after you choose the broker you want, need to investigate how long already the broker in the market. So you need to go to your Google, so you just type the Paperstone, maybe history started, like that. So you will check their history. So for the Paperstone is about 2010, so about 10 years already. So let's check IC markets, how long in the market already. IC markets is about 13 years already. Okay, the usually more than 10 years is quite reliable. Oenda, let's check. Can check on Oenda. 2001. Oenda is long already, because I think Oenda is quite considered quite good also. Okay, so is Oenda ECN or not? Let's check. Oenda ECN or STP. Oh, Oenda is not ECN broker, is a market maker. Okay, so you need to check your broker before you sign up. Then after that, you want to check, let's say you go to the list here, this website, register fca.org. Then you key in here your broker. then you will come out, you will see authorized or not authorized. Then you will see here IC market, but they come out two names here. So which one is the real IC market? So let's open up. So this one, unauthorized one, their website you can see here is not a correct website, which IC market website is this one, icmarkets.com. okay, but this one showing that I invest capital markets, so which is unauthorized, which is let's see, still got the website. Sometimes the fake website, they are not no longer exist, okay, because they will scam your money, then they will go already. See still existing or not? Oh, no more already. It's available for sales, okay, so it's no more already. Then we come to, so this one is the IC markets. So you see the email is icmarkets.com. If you want to check further, they got the licensing number, everything here. Then you can see the page usually put at the bottom here, they got to mention their license number, everything, the detail here. So we can match the detail here to this page, this website, registerfca.org.uk. okay, hope you can learn something. Thank you. Okay, now we're going to discuss about this one, who involved in forex market. So first of all, why we need to understand who involved in this market? Because in the market there's a 96% in the experiment, they have inside the research, so they say that 96% people in the market are losing money and only 4% of them are earning money in the profit. So who are the 96% of people, which is retail trader, which is holding a small amount of capital. Then who is the earning money one? Usually is the big boys, they are earning money, okay. So in this game we want to become a 4%, okay, 4% of people. That's why we need to follow big boys, okay, we need to follow the big boys. Okay, so let's see who are the big boys. So the big boys, they involve like commercial traders, professional traders, hedge fund, big international banks, and market maker. So they are considered as a smart money, okay. So because they have they are large trader with big amount of capital. Because like a bank, right, a lot of people that invest their money, they give the money to the bank, they help them to do some investment. So that's why they got a lot of capital, big amount of money. They're able to move the market and manipulate the market, so that you can see sometimes your market moving up high very fast and come down very fast also. There's a stop hunt and this and that. So that's why we need to follow what big boys is doing. That's the reason. The only way we can do it is just study the volume, see what is the footprint the big boys doing, okay. So for the dumb money, which is they are giving the money, they keep losing the money. So in this forex market, which is zero sum game, we have a seller and buyer. So there's a known the amount of the money, right, will be the same, okay. Seller give to like buyer, give to seller, seller give to buyer, like that, the money, okay. So there's no extra money in the market, but someone making money, someone will losing money, okay. Then another way around, someone is making money here, someone will losing money here, okay. So that's no extra money in the games. So if you are earning money, meaning that opposite way and another person is losing the money, okay. So why they are so powerful and making the money? Because they got a lot of capital, a lot of money, and they're able to access more information and knowledge about the market, like a news. They will know where is your stop loss, where is your pending order, where is your limit order, everything. So they will move the price to hit your stop loss and hit your limit order, everything. Then they'll just make the market, manipulate the market. So due to the large size of their order, so these traders are not able to hide their action. So each action they do, they affect the price movement. So if they affect the price movement, you're able to see in the tick volume, because tick volume will trace the movement of the price. The more larger size they put into the order, the biggest the movement inside the market. So we will see the changes in the tick volume there. Okay, now this video we're going to discuss about the price cycle and market stages. Okay, as previous course you have learned market stages. There's a 3 stages, which is ranging, okay, then expansion, then trend. Okay, trend. Okay, then after that we'll go back to ranging again. Then we'll go to expansion, then another trend again. Okay, so for the price cycle, they'll say that the price over here, they are making accumulation, the big boy making accumulation. So the price here, the big boy is making distribution. Okay, then this one is a markup and markdown. Here, markdown the price going down. Okay, so what is the purpose for these stages? This stage accumulation, big boys, they will bring, you see the price bring up down, right? So they were coming, a lot of sellers coming in. Okay, then they tend to buy at the low side here. They accumulate. Why they need to separate their orders so many in a small order? Let's say they got $10 million. 10 million. Okay, so now they got 10 million fund they need to invest. Okay, let's say they have to separate out. Okay, they put 1 million here. They cannot put 10 million together, because once put together the price will be shooting up. Then they have no time to fulfill all the rest of the money. So they need to put, let's say, only 0.5 million, 0.5 million, then 0.5 million here, then 0.5 million here, then another 0.5 million here, then 2 million over here. Okay, so let's say here everything they put in, they managed to put in about 4 million. Okay, 4 million. But in their hands, they got $6 million. So when they're doing the markup and markdown, they accumulate another $2 million. Okay, so it's 6 million now. 6 million now. Then after that, they mark up the price up, break through the ranging here. Then after that, retracement here, maybe they put in another $2 million here. So after that, the price is moving up, then retrace, moving up, retrace and moving up, right? So now they are using about 8 million already. So here maybe big boy put in $1 million again. Then here another $1 million, like that. Alright. So this is the price cycle and market stages. Then after that, the stages repeat again. They will go to become ranging. Then now they are doing expansion. Then the price markup. Okay, so what is the purpose for the expansion? Expansion, this one is to trap even more order inside, because when you do the ranging, a lot of stop loss they place it over here. So before they mark up, they need more. They need to fulfill their buy order, so they have to hunt the stop loss of the buyers. Once they hunt the stop of the buyers, then they will move the price, go up. Okay, so here will involve a lot of retail trader and all the big boys. They were coming in. Okay, so they will absorb all the order from retail seller. Okay, so when they mark up the price under here, then they start offload their order. They buy over here. Their target is at this range of the price, so they offload bit by bit over here. Okay, they offload their buy order, then they increase their order, sell order, so they become seller right now. They slowly offload their buy order with a profit, then they are taking in the sell order now. So after that, they mark the price down again so that they can making more profit. Okay, this is how the big boys making money, and how evil is the big boy. He will hunt your stop loss here and there. Alright, okay, thank you. Okay, this chapter is quite important to understand why 96% of people in the market are losing money. This because of the evil of the big boys, and they do some manipulation of the price. So they will hit our stop loss, hunting our stop loss. So hit our limit order everything. So this is the reason why people losing money, because they can able got the power to push the price up or down. Okay, let's say you have learned the market stages already. This is ranging, then expansion, then this is trending, right? Okay, so the evil of the market, they will push the price upward to hunt the people. So a lot of people, they are learning, basically they are learning the price action only. So they are in the internet, you can see a lot of, they say, okay, breakout trading system. Once the price break up, then they will buy, break out here, they will sell it. Okay, so this design, okay, to trap all the breakout, okay, all the breakout buyers, okay, they will this kind of pattern, they will trap few type of people. First is a breakout trader. Second, this is pullback retracement trader, because pullback, then they enter the buy also. Okay, so they will trap these two kind of the trader. And the third one is the level. For those who trade the level, like the level trader, they one hit they will buy, one come out hit here they will sell, like that. So three kind of trader, they all will trap over here. Once the price move up, then go down again, then forming a pin bar here. Okay, so this is how they manipulate the price. So there's a few ways for them to manipulate. They able to create an artificial and false misleading, you see, appearance respect to the price. So this is like the misleading and false breakout. Okay, so usually this happen during the like sometimes they will just before the news or after the news. They do fun running before the news, then after the news they will see, let's say, okay, let's say now the trend is going up. Okay, so they doing like that. So when the news come out, right, so let's say this one is a euro USD. Okay, let's say the euro, the news come up eventually is bad news. Okay, come out as a bad news. Okay, so but expected is bad, worse than expected. So that's mean the market going to move down, right? So everyone jump into the sell. Okay, sell side. So but sometimes the big boy, they're coming in and then buy, the market was still pushing up. Okay, the market was still pushing up, because the market, it won't based on only one news, then will affect the whole trend already. They based on their country economy, everything, a lot of news combined together. But based on one news, maybe will affect temporary going down. But when going down, then the big boy could start coming in, because the price is very cheap now. So they are using the news to push the price down, let the retail seller push the price down, retail trader, sorry. Then end up they will buy it over here. Okay, they will buy it at a cheap price, then they move the price upward again, then they are gaining a lot of profit. So they'll create an illusion. Okay, it's like illusion. So let's say okay, let's delete this one first. Okay, so let's say the price now moving down, right? Okay, so when they are doing sell, they need buyer to enter their sell, right? So after that, they, because now until here so low, there's no more buyers, because they need buyer to sell. So they will just put in some buy order over here, enough to push the price upward, to create an illusion. Okay, to create then you can see the buy come up here, but now still not much buyer yet. Once the price moving upwards, still not much, but until here everyone is coming to buy already over here. Okay, when everyone turn to become buyer, then this one, because initially they are buying, right? The big boy now sold out all their stock, okay, sold out everything within half an hour. They sold out everything because very short period, because they accumulate their buy here in a shorter time frame, okay. In a Over here they sold everything out, then the price will drop drastically, okay, very fast. So when okay when everything is drop so fast, then it will trigger a lot of things. Okay, let's say when, okay, now we sorry go back to the start over again. When the big boy is buying over here, right? When they push out some money buy over here, then push up the price, right? Then going down, then they put some money bring up the price again. When the computer algorithm, like the robot, right, like EA, they are created to the signal when they receive a buy signal over here, because now it's uptrend, so they see the price moving up, the robot everything they will buy. Then not only the robot will buy, and the retail trader, then which not using the robot, not using a computer algorithm, they will come in and buy also, especially they will buy over here, okay. Then the big boy will start short it, then will sell everything out, then turn to become seller. Okay, after turn to become seller, the price dropped drastically. Then by then a lot of people notice that the price is dropped, so they hit their stop loss here, because when they buy, right, a lot of buyer hit their stop loss here, and they turn to become seller. Then even more seller coming in, okay, then you will see the price drop very fast. Okay, this is how the big boys manipulate the price to get a better price and get more buyers coming in, because when their price is too low, no buyers, no one want to buy, they cannot bring the price go further down. So this is the tactic they use to bring the price downward. Okay, so sometimes this one they can happen during the front running, because this one is just they already know the news, because they at the institute bank, they know the news ahead before, so they know the news going to be bad or good. So against they use the tactic, okay, this kind of tactic to short the market. Okay, then if there's a holiday before this thing, right, holiday is a great time to do this kind of fund running also. So usually this one big boys, right, they not only one hedge fund, they need to combine a lot of hedge fund to do this kind of thing, because they need a lot of amount of money to push the market. Okay, but they're not only one, they can because they are in a private group, so they can call each other, they can have a private meeting, so that everyone they are stand in the same line against the retail traders like us. So this is the reason why we are losing money, because everyone when turn into buyer, then they will start to short the market. Okay, so another things also, they will release the rumors and the news, like analysts, they are works in the investment bank, right? So if they are work in the bank, so they are work against their company, because their bank is trade for their a lot of their investor, right? So they need to earn money for their investor, so they won't let because if the bank say buy, right, they buy for the investors, so they might release some rumors, the fake news, to the publics. Okay, analysts will say that this one maybe is too high, the price now is not too good, give a bad news to the public, so everyone will start shorting the currency, then they will start buying it is in the cheaper price. Okay, so if they want to go long, they will give some negative news. Okay, this is how big boys they manipulate the market. They can pump and dump. Okay, pump dump is a meaning that they also using the term in the this one is a pump dump, the price go up like that, pump and dump. So you can see a lot of pin bar forming, right? They are pumping up a lot of money inside, good enough to push a price, but it's not too high but good enough, then they pump the price down again. Okay, they short the market again. So you can, if you go to the 1 minute chart, you can see the activity, because let's say they got $10 million in the hand. but they cannot just, if they want to short the market, right? They want to short the market, they cannot put $10 million in because the price will move very fast. They're unable to fulfill all their orders. In order to fulfill their orders, they have to do like a ranging, then they do pump dump within the ranging. Okay, so let's say this is the range. So when the market is, you see, go down, right? So they can do it like this. When the price is go down, they are shorting the market, right? But they need more buyer. So in a smaller time frame, people will tend to buy it. Then they will short over here. They will short it along the way. Then after that, they will buy a little bit, so that push the price up a bit. People will create an illusion here again, over again. Okay, then people will start buying again. Then start shorting again over here. Then you over here, usually you will see they pump the price up like a breakout, then they short the market, pump the price up again, they short the market. So you can see a lot of illusion creating like a breakout, like that breakout. So they will trap three kind of trader: breakout, retracement, and level traders. So everyone a trade will be being trapped in this patterns. Okay, this kind of pattern. For the pattern trader, all will be trapped. So you will see the volume here. When you go down to your volume, your histogram, you can see the volume is very high at this 2 point. Okay, this one is very high here and here. Okay, a higher volume. Alright, so I will go into the deeper how to analyze the price movement, the spread versus the volume as well. Alright, so I think now you'll be more understand about the what is front runnings. Okay, what is the what is the analysis job in the investment bank. The bank is not helping the public. Okay, they're helping the bank because they are paid by investment bank. Okay, it's not paid by public. Alright, so I think that's it. Okay, this is more about the manipulation.